Double exclamation mark July 2025. The Central Bank of Malaysia quietly drops a bombshell in their latest financial report, and almost nobody notices. Buried deep in the pages. One single sentence changes everything. Private tokens such as XRP may be widely used as means of payment outside the banking system in the future, replacing cash in circulation or bank deposits. Let that sink in, replacing bank deposits. And in the same breath? Bitcoin and Ethereum, the two largest cryptocurrencies by market cap, are dismissed as unsuitable payment instruments due to lack of scalability. This is not speculation. This is not rumor. This is a central bank speaking. So, what does this mean for XRP? For the global banking system? And for the future of money itself? Let's break it down. For years, we've heard central banks tread carefully around cryptocurrency. They've praised blockchain innovation, while warning against volatility. They've tested central bank digital currencies, CBDCs, but always kept the public narrative that crypto could never truly replace money. Until now, the Central Bank of Malaysia's July 2025 report marks a turning point. This isn't some crypto influencer hyping an altcoin. This is a regulatory authority, acknowledging that XRP could become the preferred medium of payment outside the banking system. Why does this matter? Because central banks are not in the business of hypotheticals. When they mention a private token like XRP in an official report, it's because they see structural potential. And that potential points to a seismic shift in global finance. Here's the other side of the report. While XRP gets a nod of legitimacy, Bitcoin and Ethereum get written off, at least in the context of payments. The central bank cites lack of scalability as the reason. Let's unpack that. Bitcoin processes roughly 7 transactions per second. Ethereum, in its current state, averages 15 to 30 TPS without Layer 2 solutions. Visa? It averages 65.000 transactions per second in peak load capacity. If we're talking about replacing bank deposits, scalability is non-negotiable. You can't run an economy on a network that jams when demand spikes. And while Bitcoin and Ethereum will always have their place as store of value, as decentralized platforms, their architecture was never built for instant, high-volume payments on a global scale. XRP, on the other hand, was engineered from day one with speed, efficiency, and settlement finality as its core. To understand why Malaysia's central bank would even suggest XRP could replace bank deposits, we need to revisit XRP's DNA. 3 to 5 seconds for settlement. Capable of handling 1.500 TPS out of the box, with the potential to scale even further. Fractions of a cent per transaction. And once a transaction is settled on the XRP ledger, it's irreversible, no chargebacks, no reversals. Now, imagine this at a national level. Instead of your paycheck landing in a commercial bank account, it's paid directly into an XRP wallet, secured, liquid, and usable instantly for payments anywhere in the world. Instead of bank deposits sitting in accounts earning 0.1% interest, your funds are in a tokenized, always available form. From a central bank's perspective, this means reduced dependency on cash in circulation, lower operational costs for payment rails, more efficient cross-border settlement, and most importantly, a way to integrate with the growing wave of CBDCs without giving up control to private banks. Here's where it gets bigger than Malaysia. Central banks worldwide are waking up to a reality. The old rails can't handle the new economy. SWIFT is outdated. ACH is slow. Correspondent banking for cross-border transactions? A relic of the past. We've already seen the Bank of England running trials with RippleNet. The UAE exploring XRP in remittance corridors. The European Central Bank consulting on interoperability between CBDCs and private ledgers. The Malaysian report isn't an isolated case. It's part of a coordinated narrative, positioning certain private tokens, especially XRP, as bridging assets between the old system and the new. And remember, replacing bank deposits doesn't just mean changing how we pay. It means changing where wealth lives. If deposits migrate from commercial banks to tokenized assets on a public ledger, who controls liquidity? Who issues credit? And most importantly, who needs banks anymore? Let's talk ripple effects, literally and figuratively. If XRP becomes the settlement asset for both private and public payment systems, demand shifts from speculative trading to structural necessity. Banks, payment processors, and even governments would need to hold XRP to operate. And when demand is structural, supply dynamics become critical. Unlike fiat, XRP has a fixed supply of 100 billion tokens, with a large portion already locked in escrow. If institutions start acquiring XRP for operational reserves, retail supply shrinks fast. That's when we could see price behavior detach from speculative cycles and move into utility-driven valuation. It's no longer, "What's the hype this month?" It's, "How much XRP do we need to process our national payments?" July 2025 may go down in history as the month a central bank publicly acknowledged XRP's role in the future of money, and dismissed Bitcoin and Ethereum as payment contenders. But remember, revolutions in finance don't happen overnight. This will roll out in phases. First, pilot corridors. Then, limited use cases. Then, a tipping point, where the majority of payments flow through tokenized systems. And the concept of a bank deposit feels as outdated as a fax machine. The real question isn't if this happens. It's when. And if you're watching this now, you're already ahead of 99% of the market. Stay sharp, stay informed, and maybe hold on to that XRP a little tighter.